Let's start with chapter 7. In this chapter, we're going to be covering internal control and cash. So we've gone over merchandising, we've gone over how merchandise pay, all the details within merchandising, accounting, accounting for merchandisers, and now we're going to go into how do we control things like cash? How do we account for those things? How do we make sure that nobody's stealing from the cash drawers? How do we make sure the bills that are being paid are really paid? A lot of theft, there's a lot of fraud that goes on in business, and there's different internal controls and things that we need to put into our business to make sure that we're accounting for the cash and that we are not having items being stolen or assets being stolen or the company's not being taken for a ride. So let's look at this. Let's go over each section. We're going to be covering under section 1, we're going to define internal controls and describe the components of internal control and control procedures. Section 2, we're going to apply internal controls to cash receipts. And section 3, we're going to apply controls to cash payments. And section 4, we're going to explain the internal controls associated with and journalize petty cash transactions. In section 5, we're going to explain the internal controls associated with internalized debit and credit card sales. And section 6, we're going to demonstrate the use of a bank account as a control device and prepare bank reconciliation and related journal entries. And section 7, we're going to use the cash ratio to evaluate business performance. So let's look at section 1. Define internal control and describe the components of internal control and control procedures. So what is internal control, right? What is internal control and how can it be used to protect a company's assets? So a key responsibility of a business manager is to control operations. Internal control is the organizational plan and all the related measures adopted by an entity to safeguard the assets, encourage employees to follow company policies, promote operational efficiency, and ensure accurate and reliable accounting records. So, internal controls are regulations or rules that are being established by the organization, right? And this is usually passed on through the managers and through different sections like accounting. They make sure that these controls are being followed. They're just these measures that we put in to make sure that people aren't stealing, they're following the right procedures. We can also lose money by errors, right? So if you've ever worked at a business where the people are handling a lot of cash and they're doing things that where if there's a simple error that can occur or where if people do not do the process correctly, we can end up losing money. This is where internal controls come in, right? So if you've ever handled a cash drawer, if you've ever taken payments, you ever handled a register, you understand that there are certain procedures in the way that you accept money, the way that you count your till, the way you process things. All these are internal controls to make sure we do not lose out on money. So we do this by internal controls of plan and measures designed to safeguard assets. What's the number one asset we're going to safeguard? Cash, right? Other assets can be merchandise, other asset can be equipment, things like that. We're going to safeguard these assets to make sure that we're accounting for them correctly and that they're not being either stolen or used improperly. We're going to encourage employees to follow company policies, and these policies are developed in the best way possible to save these assets and make sure that we're not being wasteful. We're going to promote operational efficiency. And in efficiency, we learned if you take economics, you find out that most businesses and the way the economy runs at best possible is to be efficient, to use all resources to their maximized potential, right? So that's where we're at with efficiency. And so promoting efficiency is promoting operational efficiency. We're using all of our assets to our best ability and not being wasteful. And we're going to ensure accurate, reliable accounting records. And that is one way to make sure that we are not being taken advantage of and that we are not being wasteful. So, some of the things that have developed over the years because of fraud, waste, and abuse is one of them is Sabin's Oxley Act, or we know it as SOX. So, the Committee of Sponsoring Organizations provided thought leadership related to enterprise risk management, internal control, and fraud deterrence. COSO's mission is to develop frameworks and guidance to help companies improve their internal controls and reduce fraud in organizations, particularly looking at not giving people too much power, right? And that's where SOX comes in. We're going to talk about that more. Public companies that sell stock to general public are required by the US Congress to maintain a system of internal controls. Not only due to this goes one step further than what companies are regulated to, because not only because they have to be transparent to their stockholders but and their lenders, but also just being a corporation being regulated by the United States, they are also taking them to a higher degree of observation because of some of the things that have happened before. Congress passed the Abrams-Oxley Act, or SOX, to address public concern about various accounting scandals. There were a lot, and there's been many over the years. Like if you've heard of Bernie Madoff, if you've heard of Enron, you've heard of Tyco, you've heard of a lot of these companies. This is what's led to SOX, right? This Oxley Act requires companies to review internal controls and take responsibility for the accuracy and completeness of their financial reports. And so, a lot of people, you look at this and you see, even in 2008, there was a lot of companies that were over leveraged, they were taking out too many loans, they were taking too many risks, that were doing a lot of things that maybe were legal but not beneficial and not efficient, but also not very beholden to their shareholders. Now, officers like the CEO and CFO, and they now have to know what's going on within their company, right? So some of the provisions of SOX: public companies must issue an internal control report, which is, we've always had to do this. This is an audit, which is reported by management describing its responsibility for the adequacy of internal controls over financial reporting. An auditor must evaluate internal controls. So not only do we have audits anymore, but now we have internal controls that the management has to sign off on and say, hey, this is where we're making sure that we're taking care of everything, that we're being responsible with all of our procedures, and we're doing things that will not either end up in fraud or not end up losing the company money. The PCAOB board, the Public Company Accounting Oversight Board, oversees the work of auditors of public companies. And so we have FASB, we have other regulatory bodies, but the PCAOB is the body that oversees all audits. So make sure you keep that to mind, because that will come up later in your accounting career. You'll have to know who monitors what area. Accounting firms are not allowed to audit a public company that also provides certain consulting services for the same client. This is a problem that we had with Enron. Enron was being audited by Arthur Anderson, and was being allowed to get away with a lot of things. They were putting a lot of things that were really liabilities and losses, and they were able to put that on their books as assets and improve all of their revenues every year, because they just pretty much were able to lie on their books. And they were able to do this because Arthur Anderson, when would do their audit, would allow them to do this. And now Arthur Anderson was really swayed by Enron, because most of the business, they did a lot of business as being auditors, but they did a lot more business with Enron as being consultants, right? And they consulted with Enron and they shared in a lot of their profits. So whatever they did, if they were to say that Enron was failing, it would make them look bad as well. So they were persuaded in that direction to cover up a lot of the audits and make them look a lot better than they did, just because of the consulting side of the business. Stiff penalties await violators: 25 years in prison for securities fraud and 20 years for executive marketing false sworn statements. Now, in Enron, some people did go to jail. Some people, Arthur Anderson was dissolved because of that. And they also took part in the Tyco. You can look up that. We may talk about that in a little bit. But Tyco was another one of their clients that was doing a lot of the same things, putting assets on their books that were really liabilities, putting losses on, distributing to subsidiaries, and then giving themselves profits. And this made them look a lot better than they were, and would raise their stock prices, but the stocks were really worthless and the company was really worthless. And so there used to be one more big firm. I believe it's the big three now. Is it KPMG, PricewaterCoopers, and I can't remember the last one. But then there used to be Arthur Anderson after that as well. And now Arthur Anderson is gone because of that. It was dissolved. So, the components of an internal control. A business can achieve its internal control objectives by addressing five components. What are the things that we need to look at when a company is developing their internal controls? First is their control procedures, right? What usually when you're dealing with cash and you're doing any kind of accounting process, you usually have procedures in the way that you do things. If you take in cash, you're usually told as far all the way from taking in and settling invoices for accounts receivable or accounts payable, and then to all the way to the person who takes payments at the cash register. There's control procedures of how you do each step. Risk assessment, you have to see how risky is it for this person and how can you make it less risky, right? And we'll talk about this a little bit later of why you develop certain people have certain powers and why they don't cross over into different sections. Informational control, informational system. What kind of system are we using? Is it something that it's easy to, is it just a pencil? We're doing everything on Excel. Are we doing everything by hand? Is it something that can be automated and is easily fooled or is easily manipulated, or is it something very hard to manipulate? Monitoring of controls. How do we monitor everything? Are there cameras? Or is there a daily reconciliation? All these different things. And then the environment. An environment's a big deal. I don't know about you, but if you've ever worked in a place where it's okay to do something that really shouldn't be okay, but if you have that environment and it changes, that really persuades people to do things that they really shouldn't, right? Internal controls are monitored by internal auditors. So that's employees of the companies. A lot of corporations and almost every corporation will have its own internal auditors that go around and make sure that procedures are being taken care of and being done correctly. And then you'll have external auditors, outside accountants that come in and audit the company. And not only do you think of an accountant and you're only thinking of maybe are they checking the books, is are all the financials correct? But internal external auditors, when they come in, they don't just look at your books and your finances. They actually look at all the procedures it takes to create those journal entries, to from the beginning of receiving an invoice, receiving a bill, issuing an invoice, issuing a bill, all the way down to the payment, to journal entries, to the ledger. They look at all the procedures that are taken and then analyze each one of those procedures, right? And that's what internal auditors should be doing as well, making sure that there's no room for improvement or there's nothing they can change to make things better. Now, when we look at things, the procedures of internal control should be competent, reliable, and ethical personnel. So that's one of the first things that we need. Anytime you're having people deal with a lot of money, you want to make sure that you have people that are very competent, because a lot of people, a lot of accidents I've seen happen in some of the businesses I've worked for. It wasn't that people were trying to steal. I've had a company that lost thousands of dollars just because the person that was in charge of mailing out the checks, I don't know how he did this, but he accidentally put them in the wrong bin and they got thrown away. And these were like live checks. And it cost us hundreds, if not thousands of dollars to go back, cancel all these checks, have them reprinted, make sure that none of these checks, and these are already signed checks, they're going out to shareholders. And it was just a crazy thing. It was just, and he wasn't that he did it on purpose, he was just incompetent, right? And you have to have people that are reliable. You need people to show up on to work every day, or that are going to be, you can count on them to do their procedures correctly, and ethical, right? You don't want people that don't see stealing from the company as a bad thing. Assignment of responsibilities. Now, here's how you can always double check, right? Assignment of responsibilities. You never want to give people too much power, and that goes into separation of duties. Many of the frauds that we'll see, if you read your book, you'll see a lot of frauds. And if you ever watch any shows where you see a lot of people stealing from the company, a lot of the times it's because they don't have this separation of duties. And separation of duties divides responsibility between two or more people to limit fraud and promote accuracy of accounting records. If you give somebody too much power, if you're allowing the same person who receives the bills to go ahead and invoice, to go ahead and journalize those bills, and then write the checks and approve the checks or approve the payments to pay those bills, then somebody has too much power. right? And a lot of times this has happened in small companies that deal with a lot of money, but they don't deal with a lot of clients. They don't deal with a lot of transactions, but there's a lot of transactions as far there's a lot of money within, there's a lot of revenue within that company. You'll have a lot of people that go off and they start creating companies and sending invoices to themselves and then paying those invoices out to themselves, and there's no one to check that, right? That's what happens when you don't have a separation of duty. Separating operations from accounting, right? So we separate people that actually make the deals, that make the purchase orders and doing all that separate from accounting, right? The people who actually make the payments or collect the invoice. And that way they can, and then you'll even have separating the custody of assets from accounting, right? So the people that pay the bills are not going to be the same ones that receive the invoice and journalize that invoice. They'll make sure that everything is correct with that invoice, that company's real, and that it's a valid invoice, and then they'll pass that on to somebody else who will make the payment, right? So the custody assets, the money, the people that are inputting the journal entries and doing all that stuff, they're not going to be the ones sending the checks. Audits. Internal audits are performed by employees of the company. So those auditors, it's dependent on how well the company does, right? I've seen some companies where I've worked for and some corporations I work for where internal auditors were just, man, we did not like them, right? They were the people that were always nitpicky and made sure you did. And I can give you an example. When I was in the military, I worked on F-16s and F-117s, and everything had to be done by the book, right? But there were some of the things that we did that we constantly did them all the time, and servicing was one of them. And we knew how to service an aircraft with different fluids and stuff like that, and we knew it like the back of our hands, but we still had to have the technical order book with us and make sure that we followed each step and we wore our PPE. And there was this internal auditing group called the QA, right? Quality assurance. And they would go around and make, and you did not want to get in trouble by quality assurance, right? Because they were the ones that made sure you did everything correct. Now, they were within our squadron. They worked with us on a daily basis, and they just really got a bad rap, right? We just gave it to them all the time. They were kind of they worked in the same position as us, but they were chosen because they were very good at their job to go ahead and make sure everybody did theirs. And their job was just to write you up, right? And so you never wanted to see them around. But they did it because when we would actually get audited by another, they would send out inspectors and we'd make sure that's the external auditors, right? The external auditors are performed independent auditors, not employees, right? So this is people outside your company to come in and check everything. Usually a bunch of CPAs will come in from an auditing firm and come and check all your making sure you're doing everything correctly. Documents, right? Making sure that everything is in you're documenting all transactions, you're keeping all your financials in correct order, and you're keeping up with everything from the notes of your financials to notes outside your financials and different you're documenting how you create procedures and how if procedures are changed that they're being updated. Electronic devices, for example, sensors attached to inventory can reduce theft. Having the sensors at the door, having barcodes on everything, having cameras, all those things help to control in a merchandising world to make sure that you're not losing inventory. E-commerce, right? So that's what we deal with today. Most of us, a lot of us don't. I rarely use cash now, and most of what I pay for is now done with a card. And now it's not even a swipe; it's a touch, it's a tap. And so to make sure when you're tapping, now when you're tapping, or customers are tapping, and they're giving you their information on a card or something like that, you're not just taking in that information, you're not just taking in the card number, you're taking in that person's name, address. There's a lot of information that comes with that. So we need something like encryption to help disguise that information and to protect that information that we receive from our customers, right? So encryption, it rearranges plain text messages by mathematical process. Firewalls limit access into a local network, right? So you have intranets and there's internet that allows everybody to access everything. When you enter into the internet, you are opening up yourself to a lot of possibilities. A lot of people that can access the internet are all available to access yours. If they know your VPN, they can come into your network. Intranets, right? This is usually where we install firewalls or we install firewalls to create an intranet is where people can only access it from a certain area, right? So the school itself has firewalls and has an internet. So when I log in at the school and I start doing stuff on some of our platforms and some of the programs that we use, it's only accessible from computers there at the school unless I have a VPN that actually allows me to get into that firewall, right? So firewall walls keep certain people out and allow people to stay within a certain internet. Passwords, pins, and signatures. If you're like me, you have about 1,000 of those. So you have to make sure you're keeping track of all those things and you're making sure that you're doing correctly and not just making the word password as your password, right? Other examples: fireproof vaults, alarms, loss specialists, fidelity bonds, mandatory vacations, and job rotations, right? Mandatory vacations, right? Why is that important? A lot of frauds have been found out by mandatory vacations and job rotations, right? When somebody gets good stealing and doing things they're not supposed to, they rarely take a day off and they rarely allow somebody else to do their job because if they did, somebody else would see that they're doing stuff they shouldn't, right? And so a lot of times people that have been committing fraud for years finally get found out because they ended up getting ill and somebody had to come and do their job for a couple weeks and they find out, hey, this person's been stealing from the company for the last 2 months, but nobody from the last 20 years, but nobody ever knew because this person never took a vacation. So if you ever work for a bank, you ever work for accounting firms, not so much anymore, but a lot of financial institutions, if you work in an office where you're handling money or you're dealing with a lot of finances, you will mandatory that you take a vacation every year and it has to be for a certain amount of time. So every year I had to take 7 days off or take a week off and somebody else had to do my job. And job rotation also allows this. So some places where you can't take mandatory vacation, a way they allow you to, or a way they get around this is they do job rotation. So now for 1 week, you're going to be doing somebody else's job and they're going to be doing your job. So data analytics and accounting, cryptocurrencies such as Bitcoin, Ethereum, and Ripple are mediums of exchange that have no actual value or physical form, are not legal tender, and are not backed by any government or legal entity. So a lot of us now are dealing with Bitcoin and we use it as currency, but it really has no backing or anything like that. Now, before you go off and say, hey, but the dollar doesn't have a backing either, it actually does, right? It's not a coin based backing or a gold based backing or a precious metal based backing as it used to be, but it is still backed by a government and it's backed by the GDP of the United States, right? So what we produce and what we create here in the United States, we used all of those goods and services and products that we create to back up that currency. So we have some kind of backup or some kind of form of showing that, hey, this is worth something. While cryptocurrencies really do not. Now people are backing it with dollars, right? So a company might accept cryptocurrencies because they are more resistant to counterfeiting and provide faster, more secure transactions. And that is, and a lot of cryptocurrencies do not use middlemen, right? So, or most of cryptocurrencies, right? So it's just from buyer to seller straight. You learn about the Fed and how it clears checks and how it does. There's always a middleman, right? If you're using a Visa or a credit card, MasterCard, any credit card company or debit card, there's a middleman. There's a bank that then promises to pay through your account or promises to pay on credit to that company through you. Cryptocurrencies work on a blockchain. This is a special code that is only given to that certain crypto, that specific currency that you are using is just a chain of numbers and letters that are only derived for that. So every cryptocurrency is special in that it is different from every other one. The limitations of internal control cost and benefits. Internal controls cannot completely prevent fraud, right? They're only there to help deter it. But if somebody is determined to steal or to rob or to take away from a company, they will do it, right? Collusion is when two or more people work together to circumvent internal controls and defraud a company. Sometimes you can have internal controls where it takes one person supposed to watch another, but if these two people collude on making it their priority to steal from the company, then there's no going past that. There's no getting around that. The stricter the internal control, the higher the cost. Internal controls are judged based on upon their cost versus benefit. So if I run a company, right, I can only do something that's going to be cost beneficial. So if I hire a security guard to make sure people don't steal from the store, right? But I run a dollar store, and the most somebody can walk out with, even if they wanted to, they could steal maybe $100 worth of, realistically, if somebody steals all they can and they steal $100 worth of product, they can barely make it through the door and make it to their car. And most of the time I can call the cops and they'll find that person pretty quick because of all the mass they have to take, right? So say I may lose because of that, people steal a lot of small things, and it just helps that I have cameras and that I'm able to see as they steal. And maybe I lose a $1,500 in product every year in merchandise, right? Not saying that's a good thing, right? But it doesn't constitute me hiring a security guard at the door that I'm going to have to pay $40,000 to, right? The loss of 1,500 doesn't constitute me hiring a security guard. It's gonna cost me 40,000, right? It has to be cost effective, whatever internal control that we use. Let's look at the second section of this and supply internal controls to cash receipts. So, what are internal control procedures with respect to cash receipts? What are cash receipts, right? Cash receipts are occupied primarily when a business sells merchandises or services, and they're dealing directly with the customer or somebody who pays them at the spot. So, what we're usually talking about here is a retailer or a merchandiser that sells directly to a customer that's going to pay them in some form of cash payment. So, each source of cash has unique security measures. A receipt of cash over the counter in a store involves a point of sale terminal cash register. And this is something that you can monitor throughout the day. I don't know if you've ever had a cash drawer, but usually you count your till when you first start, and then you take in your sales and you take in receipts, you take in cash and payments, and then you count your till at the end of the night, compare them to your receipts, and you should have a certain number to make sure that you've taken in the right amount and that so the right amount has gone out. Many companies receive checks by mail for payments for service or merchandise. Several controls are needed for cash receipts by mail. If you're receiving payments by mail, there's also procedures for that. Usually the payment comes in by mail, somebody receives it, and then it is recorded, right? And then it is, especially if it's a check, that check is this then endorsed. Most companies will endorse the check, so it is deposit only. That is then we put in that endorsement, send it in as a deposit. Once that deposit is received and the bank receives the funds, then that money is then flowed into the company and marked as we mark bills as being paid then. So let's look at how this flows. Cash receipts by mail. So the mail room starts, they receive a check, who is then given to the treasurer. The treasurer then develops a deposit ticket. That deposit ticket then goes to the bank. Then the bank posts that in the bank statement, right? And then the controller is able to view that in the bank statement. And so at the same time, remittance of the advice is the accounting department. So we also, when the mailroom has the checks, and then they also say, hey, we received this payment that goes to the accounting department. The accounting department posted to the cash, right? They make the journal entry to post that amount to the cash as that payment is being made. And then the controller double checks with the bank. So when the controller double checks with the bank, then that is what is really posted to your books or an adjustment is made, right? So the controller is going to make sure that all the payments are received. The accounting department will post a payment, but then it's up to the controller to make sure that payment is posted. If, say, we get an NSF, not sufficient funds, and that check bounces, or the check is short, or something happens, and the payment didn't go through, the bank it could also be that the bank didn't see the check is not readable and they don't accept it. And so then that will also come out in the statement, and the controller will have to either send that back to the accounting department and have her send another invoice, or they would also have to do the journal entries to reverse that payment out and put it either now back as an account receivable. So, step one, all incoming mail is opened by the mailroom employees. The mailroom then sends all customers' check to the treasurer and all remittance advices to the accounting department. What is an optimal attachment to the check that tells the business the reason for the payment. So, this goes to the check goes to the treasurer who accepts the money, deals with the money side. The accounting department, the remittance advance. This is to show them, hey, this payment came in for this customer's for an receivable that we are going to see. The treasurer has the cashier deposit the checks in the bank. The cashier receives a deposit receipt. The accounting department or bookkeeper uses the remittance advances to record the journal entries to the cash and accounts. So this is where we receive the cash and we now lower the account receivable. And on the other side, the treasurer is sending that money into our bank, and then that bank is sending us a receipt for a deposit saying, hey, this is going into your account. As a final control, the controller compares the flowing records of for the day. So the bank deposit amount from the treasurer, he'll get that bank deposit, or he or she will get the bank deposit amount and be like, okay, this is what was deposited into the bank, and then debit to the cash and the accounting department. He'll look at the journal entries and go, okay, is this what the journal entry shows that we received from the client? So both of those have to match up. And then we'll talk about, I was talking about if there's an NSF or whatever, that's going to be done in the bank reconciliation. So sometimes we have a lockbox systems, and it's a system in which customers send their checks to a post office box that belongs to a bank. And this is by doing this, they send the check to a post office box that belongs to a bank. They're skipping all the other process. A bank employee empties the daily box and records the deposits in the company's bank account. And this way, the company doesn't record the purchase. There's no advance or minutes advance advice for the accounting department because we do not actually touch the check. The company never touches it. The bank touches it or handles the deposit, and based off what the deposit slips that we receive or the notification from the bank, that's when the accounting department then enters the journal entries to show that certain payments have been made. All right, let's continue with 7.3. Apply internal controls to cash payments. So, what are the internal control procedures with respect to cash payments? Now, we looked at checks, so what we receive in the mail. What happens when we receive cash, right? Companies make many payments by check. Payments by check provide internal controls. A check provides a record of the payment. A check requires a signature by an authorized official. So these are different internal controls already that are included with the check, right? Supporting evidence is reviewed prior to signing a check. So a check has a lot of internal controls that just come with it, right? It gives you a record of the payment. It has to be authorized. There's evidence, right? Because you have to have some kind of deposit. It's going to show up in some kind of bank account or some process. So that's a lot of internal controls that come in with check. Cash payments by check, right? Will follow in this order, and we'll talk about it. One is the purchase order, two's merchandise inventory, and then or an invoice, and then we have three's receiving report, and then four is the check. So one purchase order goes out, electronics manufacturer goes out, makes the inventory, smart touch learning, they receive the report, and also at the same time that we receive the merchandise, an invoice is also coming out to us, right? So at the same time we're ordering invoices or we're ordering inventory, right? The inventory is getting ready to come to us and being sent to us. We're also receiving an invoice. And then once we receive that invoice, we have the receiving report that we receive the product. We send out a check for payment. And that goes back out to the electronics manufacturer. So let's look at that and break it down step by step. Controls over payment by check. The controller or the treasurer should examine a payment packet to prove it receives the goods or orders, right? So here's a payment packet. The packet includes a purchase order, right? Purchase orders means that is what we sent out, and that is showing how much of what we ordered, right? What's the details of the product or merchandise that we ordered for inventory. An invoice, what was charged to us, right? That's the kind of a bill, right? And then receiving report is what taken of an inventory of what we received, right? So did we receive 4 pallets that included this? Each pallet's going to say, or each package will say how much it's received. And depending on what the company is or what the product is, their account, right? And so that's also going to be on our receiving report. So these three show that we received the goods ordered. It is paying only for the goods received and authorized, and it's paying for the correct amount. So this way we can say, hey, we ordered this much. They invoiced this and said, say we ordered 500 tablets. The invoice is for 500. We're just making sure that we receive those 500, and then that's what we're paying for, right? If there's anything in messed up within those three areas, we can go ahead and check and make corrections if needed. So there's some of those ways instead of doing a paper trail, we can have a streamlined procedures. The evaluated receipt settlement ERS is a procedure that compresses the payment approval process into a single step by comparing and receiving reports to purchase orders, right? So instead of going through and having all these different invoices and everything, what we can do is we compress the payment approval process into by comparing receiving reports, what we got to our purchase order, and not even looking at invoices. We just say, this was our purchase order. What did we get? Okay, we know how much we pay. That is an evaluated receipt settlement. What we now have is mostly electronic data interchange. It's a streamlined process that bypasses paper documents altogether. Computers of customers communicate directly with computers of suppliers to automate routine business transactions. Why would you allow your supplier or your customer to go ahead and streamline with you? The reason being is that you can receive supplies a lot faster. You don't have to start planning out. The system itself monitors your inventory and notices when you're going to need and predicts when you're going to need more goods in, more materials, more supplies, or more merchandise, and automatically tells your client or your supplier, "Hey, this is what we need. We're going to need it by this date." And it automatically does it, automatically fills out all the paperwork, and that way you communicate and you have somebody oversight when it does the payments. But this way you're not running behind and you never run low on merchandise or supplies. Let's explain the internal controls associated with and journalize petty cash and transactions. Petty cash is going to be used with a lot of other companies, a lot of smaller companies. We used it at the college, right? So I was actually in charge of the petty cash in the business office. And let's talk about it. So, what are the internal control procedures needed for petty cash, and how are petty cash transactions recorded? So, here's the thing: you don't want to do a lot of petty cash. Is a fund containing a small amount of cash that is used to pay for minor expenditures. You don't want to have to do invoices and all these other things for very small purchases that you might need for in and around the office or in and around the building, right? Let, let's say that you are going to buy, you're going to go ahead and purchase stuff for a small birthday party. You need to buy paper plates and some cups and things like that, right? And you don't want to have to go and issue the person that's doing it. A lot of companies have bypassed petty cash by issuing credit cards, right? But credit cards has that's a system in itself that you have to go and monitor. We won't get into that right now, but that still takes a lot of steps. So what you do is you have a petty cash, right? You have a cash box that you're allowed to give people the small amount of cash to make small purchases, and they provide you receipts. It needs controls such as a designated custodian. You have to have somebody that watches that locked box and have a designated specific amount of cash so you know exactly how much is in that cash. Like a separate little account that somebody watches and monitors for all payments to be supported with sequentially numbered petty cash tickets. And one of the things we don't talk about is receipts, right? So you have to have receipts for all the transactions as well. On August 1st, okay, so you have this petty cash fund. You have somebody that monitors it. It's just a fund. It has a small amount of money, $200. And you allow people to, or you allow employees to use that petty cash for business, for purchasing things for the business that you really don't need to write a check for. You really don't need to make a credit card purchase for. These are small items that need to be purchased, but really do not need a whole system behind it. And so let's look how a petty cash fund is set up. So the first thing we do is we set up a petty cash. On August 1st, Smart Touch Learning creates a petty cash fund of $200. The custodian cashes a $200 check and places the currency in the fund box. So here's the thing about petty cash, the account itself. You are only going to use that account, petty cash, in this, and we see this transaction. Let's look at this journal entry. Petty cash debit $200, cash $200 to open petty cash fund. The only time you will use petty cash account, that account in a journal entry, is when you're either first establishing a petty cash, you're either adding funds to the petty cash, like as in growing, making the petty cash bigger, not replenishing it, but making it say we're going to say we have a lot of small things that we're purchasing, and 200 is just not enough to get through the month. We're going to make petty cash $400, so we put two or more dollars in there. That's when you'll use petty cash. Or when you close it out, say we no longer need petty cash, we find that it's not really useful and we're just going to close it out. That's the only time you're going to use that account, petty cash. So for each petty cash payment, the custodian prepares a petty cash ticket. This is kind of like a receipt, but also the person who makes the purchase should provide that person, the person who's monitoring the petty cash, with the receipt of their purchase. So you put a cash ticket 101, August 25th. This is going to show the date, the amount, what it was for, what the expense. So for letterhead, and then what account is going to be, what account are we going to attribute it to, and then who received the money, and then was who the person who runs or who is the custodian of the petty cash will also be on there too. So you're telling on that ticket, you're going to say how much is being paid, who you gave the money to, what it was for, and what's the account we're going to charge, right? And an impress system is a way to account for petty cash by maintaining a constant balance in the petty cash account. At any time, cash plus petty cash tickets must total the amount allocated to the petty cash fund. Now, in my system where we did petty cash, not only would we create a ticket, but would also, after that purchase was made, that person would have to come back and give me a receipt of the purchase that they made. It's not just who I gave the money to. It's hey, I gave them the money and they gave me back that receipt, and that's what was paid. A lot of the times when we use petty cash at the college, people would already make the purchase, and I would just give them the cash, and they would give me the receipt, and then that's how I'd make out the ticket. On August 31st, the petty cash fund holds $118 in cash, $80 in petty cash tickets. You can see $2 is missing. So at any time, just like any other account or like a bank account, and we'll talk about this later, but petty cash should always equal. So we know how much we started off with. We should always be able to add up our tickets and our cash on hand, and that should give us a total of what the petty cash is. In this example, we can see that we're short $2. So somewhere in the mix, $2 went missing. So we'll need to make up for that, and we'll need to put that cash over short. And you're going to see another account for this. This is one, but we don't show that until we go and we replenish the petty cash. So to replenish the petty cash fund, we don't use the account name petty cash. We don't use that, right? To replenish petty cash fund, the company writes a check payable to petty cash for $82 to bring the cash on hand up to $200. So what happens is the accountant or whoever is issuing the checks or the treasurer will issue. So the person who runs the petty cash will turn in all their tickets and then be issued a check that they will cash to replenish and put back into the box, right? This is where we do our journal transactions, right? So you're going to run two separate books. One book will be for petty cash and all the tickets and where that money is going to go to. But then when you're ready to replenish, then you give those tickets over to the accountants, and the accountants now will go ahead and now charge those accounts, right? They made it now. We'll charge office supplies. We'll do an expense for delivery expense, and then cash over short that $2. When we over or short, we have to do a $2 entry. And then we see cash, $82. Then a check is written to the person, or a check is written for the petty cash that is then cashed and given to the custodian of the petty cash to replenish the petty cash. And so now you're back over with $200. You never use the account petty cash. See, when we're replenishing the petty cash, we're not saying petty cash, debit, $82, and cash credit $82 to put back in petty cash. That doesn't happen. We charge the accounts for all the expenses that the petty cash paid for. When cash is missing, the cash short and over account is used to record unaccounted for amount. The petty cash account is used in journal entry only when the cash fund is started or when an amount is increased or decreased, right? So that's the only time you're going to use that account. When replenishing the fund, the company debits either the associated expense incurred or the asset purchased with the fund. So if we bought supplies, if we bought, that's an asset that we could use with petty cash. Most of the time, it's going to be small expenses that, and those expense accounts will be charged when we replenish the account. So the sum of cash in a petty cash fund plus the tickets may exceed the fund balance. Say, for example, sometimes somebody goes and they make a purchase. You give them the petty cash. Let's just say this happens, right? You give them the petty cash. You give them the cash. You write the ticket. They go and they make the purchase. They bring you back a receipt, but then they accidentally either the person that they paid for gave them back the wrong change or something happened and they gave the money back, and now you have more money in the petty cash than you did when you first started. So consider the previous example. Assume the petty cash ticket number 102 for delivery was $30 instead of $20. And so in this account, we instead of being $2 short, we're over $8, right? So the fund balance was $200. Cash on hand was 118, right? We had 118. And then we looked at our petty cash tickets, we added them up, and it says that we spent $90. We have $118 on hand. That means we have $208 in the petty cash. So we're over by $8, right? And so this is the same way that we did petty cash and replenish before, instead of having a debit, an extra expense of cash over short, right? Because we were short, we had a $2 expense and cash short and over. In this example, we're going to have a credit cash short and over of $8 because we are over $8. And so in this case, the cash on hand plus the petty cash tickets equal $208 is more than the fund balance, $200. A cash overage exists. The journal entry to replenish the fund would be the $8 over. But we're not going to pay ourselves $90, right? We just put that overage into that cash over short. $82 comes back. So now that the petty cash, that $118 plus the $82 cash will bring back the petty cash to the $200 balance. And that's because we took in $8 over doesn't mean now petty cash grew by $8. No, that $8 goes into the fund of short and overage, and the $82 comes into the account to make sure we're back at 200. Now, if we want to change the fund to petty cash, right? On September, this is now where we're going to put in a journal entry that has petty cash as one of the accounts that we're going to enter. On September 1st, Smart Touch Learning decides to increase the amount of petty cash from $200 to $300. They find that they're doing more transactions with petty cash than they usually are, than they thought they would be needing to do. So an extra $100 is needed to make sure to cover all those extra small expenses that they deal with during the month. In order to increase the fund, Smart Touch Learning must write a check for an additional $100, cash the check, and place the additional currency in the petty cash. But just like our initial first journal entry, we have to use petty cash on this one. So petty cash, debit $100, cash $100. Now a check is written out. Cash, that $100 now goes into that petty cash fund. Now, let's explain the internal controls associated with and journalized debit and credit card sales. With journalizing debit and credit card sales, there's a whole process to this, and let's go through that process. So, what are internal controls needed with debit and credit card sales, and how are these types of sales recorded? When a debit and credit card are accepted, businesses should protect customers' data with the following internal control procedures. Use designated point of sale terminals to process card payments that are in accordance with payment card industry data security standards. That can go anywhere from a small business using a modified iPad with a lot of these POS systems small businesses will use. They're more sophisticated than some of the big systems that customers companies used to use back in the day. Because technology has grown so quickly and caught up with everything, a lot of these systems for the mom and pop shops are just as sophisticated as systems that you will use at HEB or something like that. So they'll use a POS system that's very small and local, but it is still pretty sophisticated and it does help protect the customer's information. Never print the full 16-digit card number on either the business or the customer copy of the receipt. This is something that wasn't done back in the day. You're not. I'm pretty sure you a lot of us don't remember, or most of you don't remember, like when people used to take credit card payments, they would actually give the card, and there was a machine that they would make a carbon copy of the card with. And they would have all the information on it. And that's how, and then you would write how much the payment was and everything. And that credit card, the magnetic strip, there was no magnetic strip. You just had that card, and they would make the carbon copy of the card. And that's how you make your payments. And so, not very safe back then, right? Your information was given all over the place. Employees involved in the processing transactions should be trained in appropriate procedures, right? So making sure it's more credit every day. There's more and more credit card fraud being developed, and more ways to try to protect the customers, right? And more companies are being hacked, but we have to make sure that we are doing our best to protect our customers and to protect ourselves from being either having their identity stolen or our accounts being used. Refunds of credit card, debit card payments should be made by an individual or other than the person reconciling the transaction, right? So this way, just like in checks, the person that is giving back the receipts or whatever, or the refunding the person, is not the person that made the transaction. It cannot be refunding themselves. Is pretty much what you're trying to say. The storage and retention of credit card information should be kept to a minimum, right? Only what you're going to need, right? You shouldn't be taking in more data than you should, although data is king now. So a lot of companies do take in a lot of data. You got to make sure you protect it, and we can talk about that. A lot of companies are do put in a lot of measures, but it's still a lot of information is being stolen. Cardholder data should be maintained on a secure network behind a firewall and encrypted. And most companies do have that. But every day, technology is just being upgraded and being more and more produced that are getting behind these firewalls. So every day, companies have to improve their firewalls and improve their technology on how to protect customer information. Companies hire a third-party processor to process the credit and debit card transactions, right? And that's usually with everybody, and that's the companies that we know: Visa, American Express, and the companies like Square, and the companies that control the POS systems. A lot of them do this as well. Two common methods of handling the proceeds and processing fees: net. So here's the thing: most companies will do credit card sales. Some companies that do big purchases, you'll notice that they'll either give a discount or up this or increase the price when there's a credit card sale involved. And that is because these credit card companies and debit card companies charge a fee for using their product. So net, the total sales less the processing fees assessed equals the net amount of cash deposited by the processor, usually within a few days of the sales date. Gross, the total sale is deposited daily within a few days of the actual sales date. The processing fee for all transactions processed for the month are deducted from the company's bank account by the processor, often on the last day of the month. So there's two different ways to process the fees. Either they're done on each transaction, and the company receives the net, right? And every transaction, it shows the percentage of processing fee that's being deducted, or they take in all the payments, right? As a gross amount, you receive all the money, and then at the end of the month, the processor then totals up all the fees and charges one monthly fee. Smart Touch Learning sells merchandise inventory, ignore cost of goods sold, to a customer for $3,000 on August 15th. The customer pays with a third party credit card. The card processor assesses a 4% fee and deposits the net amount. Enter entry on the sales data using the net method. So when we're using the net method, we're automatically going to put in the deduction of the fee in every transaction, every journal entry that we enter. So in this entry, we're putting cash 2880. $2,880 is what the part we received, right? The total sales, and then the credit card was a 4% transaction fee. So we put credit card expense. We go ahead and expense it out right then and there because we're going to get the net amount, and we put the $120 fee. Sales revenues do not change. We still sold $3,000 with the product, right? Our $3,000 in sales, but we only received 2,880, and we were charged a fee of $120. A lot of these credit card companies charge fees that high. So if you ever see some small businesses, they're like, "Hey, I know a lot of donut shops do this." They tell you have to pay if you're going to use a credit card, you have to charge at least a certain amount because some credit cards have at least a minimum amount fee, right? So they'll charge maybe 1, 2, 3, 4%, but then they'll say you have to have at least a minimum of 25 cents, or every transaction has to have at least a minimum fee of 10, 15 cents or 25 cents. And that's why they'll say, hey, if you're going to use a credit card or a debit card, you have to purchase at least this much to cover that fee. Now, let's say that we did the same transaction, but now we're going to do it with the gross method. There's no fees on this transaction. So every transaction is done as if we just took in the full amount. Cash $3,000, sales revenue $3,000. But at the end of the month, we're going to create a new transaction or a new journal entry with a total of all the fees that we collected over the month. So under the gross method, the processor would collect the 4% fee assessed at the end of the month in August. So it would say, hey, the credit card expense was $120. Cash paid as a credit was 120 bucks. Pay fees assessed by credit card processor. But this would probably be in the gross method, we would add all of our fees, right? So it wouldn't just be $120, it'd be a lot higher. But in this example, we're just trying to show you that we process the fees at the end of the month instead of at every time we take in a new transaction. All right, let's continue with section 6, 7.6. And we're going to demonstrate the use of a bank account as a control device and prepare bank reconciliation related journal entries. So, how does a bank account have controls? One of the things that a business account, now, this is not every bank account. We're talking about business accounts here. They're a little bit different than what you would see in a regular checking account, and they have a couple different features. One of those features is a signature card. It shows that each authorized person's signature for a bank account. Now, I say that, and you may not know this, but also regular bank accounts have this as well. A signature card is mostly like a physical part that a lot of banks will have for businesses, and they'll have a physical card of that. But now it's become a digital kind of thing. If you go to your bank and you try to deposit a check or something like that, or anything like that, your bank has your signature. A lot of the times they'll have it digitally and they can compare it, and if they can tell whether you've done that or if it's some kind of iteration of your signature. A deposit ticket is a bank form that is completed by the customer and shows the amount of each deposit. This is more like a receipt to show how much is going into the account and how much is being deposited. And then you'll usually get a copy of that to show how much you've deposited and the final balance to show how much has gone into your account. A check is a document that instructs the bank to pay the designated person a business a specific amount of money. So the maker is the party who issues the check. So if you ever written a check, you are the maker. The payee is the individual or business to whom the check is paid. So the person receiving the check is the payee. The routing number identifies the bank upon which the payment is drawn. So the routing number is like a bank identification number that tells the person who received the bank that received the check which bank will be paying them or who they need to reach out to for that money to come to. And then an account number identifies the account upon the payment is drawn. So those are individual numbers, accounting numbers. The bank number is going to be on every individual who has an account there will have that same routing number, but each account number will be different. And if you have multiple accounts, each check will have a different account number on it if you have multiple checking accounts. So this is the check with remittance advice. Here we go. We have the date, description paid on account 300, check serial number. We have the maker who's made the check. Now, a lot of checks will, if as they're ordered, they will already have the name of the maker, either the business or the person, their address already inputted onto the check. The payee, that will need to be filled out by the maker, right? The date will need to be filled out. Check serial number tells us what check number was issued. The account, the amount. So you have to do the amount twice. If you see on the payee line, you'll see that it's written in who's going to be receiving the funds. And then in the dollar and numeric numbers, you'll have the amount. And then on the amount line, you'll have the written amount as well. And if you ever wondered why people draw a line, I know not a lot of us are using checks these days, but if you've ever wondered that, it's so you can't write anything after that. Then the bank is on there with its address, and then on checking accounts with business accounts, you also may have two. You have treasurer and president here. That can be something that is specified to the checks that you ordered, that it has to have these two signatures on it, and then that way that the check is valid. And then we have our routing number and our account number. And then the last three digits on there are our check number. So the what check was issued. Now, a bank statement is a report that activities in the customer's account. It shows the account's beginning and ending balances, everything that's come in and gone out of that account. It lists the month's cash transactions conducted through the bank account. Canceled checks are physical or scanned copies of the maker's cash pay checks, right? Anything that's been scanned or copied, you also can have checks. A lot of people now are doing deposits through a photograph on their phone, doing it through a mobile app or something like that. And then that's can also be considered in the cancel checks. So here's a bank statement. It tells you beginning balance. It tells you how much has been deposited, how much has been withdrawn, and then service charges. Those you will not see unless it's on the bank statement. A lot of commercial bank accounts have a service charge, and companies will pay to have extra things that regular checking accounts don't have. And then it has your ending balance. It tells you if you go into the transactions, it starts with its deposits, right? And how they were usually a deposit, and then it has its date and the amount of the deposit. Now, it also has usually deposits on there are going to be deposits through check or cash that are deposited by the account owner. And then you have electronic deposits, EFT collection from customer. So that shows an electronic transfer that went into the account on that date and how much it was for. And then it also has interest. So some checking accounts and most all savings accounts and some checking accounts do earn interest on the amount that is in that account. Service charges, that's a deduction, and then you have your first deduction is your service charges, and then you have all the checks that are written out, the amount, the check number, and that adds to your deductions, and then you have other deductions. So if you have electronic payments like a automatic bill pay, like the Waterworks, EFT Waterworks that's being paid, or and you also have NSF. So NSF is non-sufficient funds. So that means that on 425, you had a check that was deposited and for the amount of $1,200, but it was when the bank went to go deposit those funds, reached out to the other bank, let them know that they did not have enough money in their account to cover those funds. So that check was returned. And so that means a non-sufficient funds. So you also have to make sure you be aware of that you did not receive that payment. So, electronic funds transfer is a system that transfers cash by electronic communication rather than by paper documents. Many bills are paid EFT, especially if you have automatic payments. You can also do this through having a checking account set up with your utility company. I pay all my utilities and everything like that electronically. So this is something along electronic funds transfer is just something that transfers funds from my account and pays different things. EFT is less expensive than mailing a check. Debit card transactions and direct deposits are EFT. So it's less expensive because you don't have to do, and it's less work. It's usually typing a few strokes on the keyboard rather than writing a physical check, having to pay for those checks, paying for the stamp and everything else. All the physical costs that come with mailing a check are skipped through using electronic funds transfer. Now, there are two records of a business's cash. There are two ways that we track cash: the cash account and the company's general ledger. So, all the transactions in the general ledger that we track through cash, and then the bank statement, which shows cash receipts and payments transacted through the bank. So, the bank reconciliation compares and explains the difference between the cash on the company's books and the bank records. There are going to be some things that are on your books they're not going to be in your bank statement. And there are some things that are in your bank statement, they're not going to be on your books. And by reconciling, we need to take those differences, combine them, so we know what our true account balances are. The differences arise because of a time lag in recording transactions called timing differences. Some things happen and we automatically transfer them over and we record the transaction in our journal, but it may take the bank to do some things that way. Other things happen only that we can see through the bank statement, and then we need to record that transaction because we don't know it's happened until we actually see the bank statement. So, three examples is a business immediately deducts the amount from a check written on its checkbook and cash account. The bank subtracts the check a few days later. If you're like me and you pay people, sometimes you write them a check and I don't know what it is. The people who do my lawn, I pay them and they like to collect those checks like baseball cards. They hang on to them and they may do I pay them weekly and I may not see that check getting deposited for another 2 or 3 weeks, right? It just throws me off sometimes. But that's what happens sometimes. Sometimes you pay a supplier or you pay an invoice and you don't see that invoice, so those people don't turn in. They have a process when they make deposits, like at the end of the week, and you may have paid them on Monday, but you don't see that transaction happen for another few, maybe days, maybe even a week, maybe a week and a half. When a company deposits cash, and that can cause a difference because you'll see the expense and everything on your books, but you will not see it in your bank statement. When a company deposits cash in its account, it immediately adds the cash receipt to the checkbook and cash account. The bank may take a day or two to add deposits to the company's balance, especially if it's a large balance, a large deposit. Sometimes banks put some of that money on hold. Sometimes they have to make sure and clear with the other bank to make sure those funds are available. So automatically, once we receive revenue, we've earned revenue and we've done either delivered this completed the service or delivered the merchandise, we automatically put that in our books, right? And we put it as we receive cash and everything like that. That may not show up on your bank statement for a couple of days. So there's good could be a difference there. EFT cash payments and EFT cash receipts are often recorded by the bank before the company learns of them. Usually, the company doesn't know about those electronic transfers until it sees the bank statement and reconciles the bank statement. So you'll have those EFT transactions on the bank statement and not on your books, and that is something we need to reconcile. We need to make sure we get those payments or payments updated and journalized in our books to match our bank statement. So the bank side of the reconciliation includes deposits in transit. So outstanding deposits, things that we've deposited but have yet to hit our account, but we've already put on our books. So that are recorded by the company but not yet by the bank. So we've already recorded these deposits in our books, but we are yet to see them enter into our bank. Outstanding checks. Outstanding checks are issued by a company and recorded on its books, but not yet paid by its bank. So these are things, like I said, either the bank is taking a while to receive the payment from the other bank, or the company is just taking their sweet time and depositing the checks. And like I said, with my lawn guys, they take their time and they'll deposit it when they deposit it, right? That's going to be a difference there, right? We already, as soon as we know we've made that check and we've recorded that expense, it's going to be in our books, but it may not be in our bank statement. Bank errors, they either incorrectly increase or decrease the bank balance, right? So there are errors that the bank may have that may have happened that we did not catch, and these are things that we need to reconcile with our books. So the book side of the reconciliation includes, so this is what that's for the bank statement side, right? So we need to add in the bank statement side, we need to add funds that we've already deposited, but the bank yet has yet to recognize, and we need to deduct funds, payments that we've already made, but the bank has yet to receive those, and then any other errors that the bank may have. On the book side, we have credit memorandums, bank collections, or cash receipts the bank has received and recorded, but the company is not recorded on its books yet. Say that we have an EFT that we don't recognize until we see the bank statement. That's a credit memorandum. That includes electronic funds transfers, service charges. Usually, service charges we don't see until we see the bank statement. So this is something we need to record after that. That needs to be updated on the books, often referred to as the debit memorandum. Interest revenue on a checking account, that is something that's going to be on the bank statement that's not going to be in our books. So we need to take that information and transfer it over to our books. And non-sufficient funds checks are received from customer for payment of service rendered or merchandise sold and have yet and turned out to be worthless. Means that there was not enough funds. So we already recorded this revenue and this payment. And now all of a sudden we do not have that income, but we still have revenue there. So we will take this paid invoice and now turn it into an accounts receivable, reach back out to the customer and let them know that they need to pay this amount. Book errors that either incorrectly increase or decrease the cash balance in the company's general ledger. So any errors that we see that we've made on our books that are corrected on the statement, then we need to make those adjustments. A bank statement in Exhibit F76 shows that on April 30th, bank balance of Smart Touch Learning is 12,720. However, the company's cash account has a balance of 20,850. Smart Touch Learning views the bank statement and the business cash account and determine the timing differences. So, reconciling items, right? The bank balance says we only have $12,000. However, the company's cash account says we have 20,000. So there's some quite a few difference, right? On the bank side, there's a deposit in transit of April 30th, $9,000. So that's a big difference right there. On our books, we've already said that we've had that $9,000 transferred to our bank account, but the bank is yet to recognize that and deposit it into our account. On the other flat side of that, we have a check that we wrote that we are deducting from our books for $2,000, but yet the bank has yet to receive the funds, or yet to receive a request for those funds, and has yet to pull those out of our account. So on one side, our bank is $9,000. Our bank statement is $9,000 short in revenue and in cash, and $2,000 overstated in payments that we've made. On the book side, EFT received from the customer, right? So that's something that we need to update on the books that we see on the bank statement. Interest revenue earned on the bank balance. That's something that we see on the bank statement and we need to move over to our books. Bank service charge, we need to deduct our books that $20 service charge. EFT payment of water bill, we need to deduct that payment for the water bill of $40. And then we also need to deduct our $1,200 NSF check on our books. This is something we've already recorded as revenue and payment in our books, but now we find out that we did not receive that payment, so we need to deduct that amount. And here you can see the completed bank reconciliation. We have our bank side. We started with our original balance. We have our deposits. We add our deposits in transit, less the outstanding checks that we've issued. We come out to a balance of 19,720. On the opposite end, we have our book balance, 20,850. We need to add payments that we received, electronic payments we received from the customer, and the interest revenue we received on our account. That adds $130. Then we need to deduct the $20 service charge, the payment for the water bill, $40, and then the NSF check, $1,200. When we add those deductions and then deduct from the total, we see that we've reconciled and both sides equal the same amount, 19,720. So, bank reconciliation summary of various reconciling items. Bank balance, always add deposits in transit. So, to our bank balance, our bank statement, right? We're going to add our deposits in transit. We're going to subtract outstanding checks. We're going to add or subtract corrections or bank errors. On the book side, when we look at our journal entries and we look at our books, we're going to add bank collections, interest revenue, and EFT receipts. We're going to subtract service charges, NSF checks, and EFT payments. And then we're going to add or subtract corrections and book errors. And this concludes bank reconciliation on that part. And now we're going to do a different, we're going to go through a example and going step by step of how this looks. I've already explained it on there, but now we're going to go through what we just looked at. And we're going to go through it step by step. So let's go through this example that we've seen in the earlier slide. It says that we're going to look at the bank slide of the reconciliation. So this, we're looking at the bank statement. In the beginning of the bank statement, we're looking at a balance of 12,720. Now, what do we have to add? What do we have to take away from this bank statement to make it reconcile with our books? The first thing we need to add in is deposits in transit. So these are deposits that we've made that have yet to show on the bank statement. So deposit made on April 30th for $9,000 is yet to be recorded by the bank, must add to the bank balance. So that we already have on our books, we need to add that to our bank statement. We have outstanding checks that we know we've written and we've already deducted and put the transactions and the journal entries in our books, but are not showing on our bank statement. So these are our outstanding checks. So check number 204 for 2000 is outstanding and must be subtracted from the bank balance. After all items affecting the bank side have been identified, the adjusted bank balance is determined. So once we add that 9,000 and then deduct this 2,000, we should get what we match in our books, given that we take what needs to be given, what needs to be changed in our book side. So let's see. Let's look at the book side of the reconciliation. So on the book side, the beginning cash balance was taken in journal ledgers $20,850. What do we need to add? What do we need to subtract? So we have some electronic fund transfers. We have an electronic fund transfer receipt from a customer in the amount of $100 not recorded in the cash account. Must add to the book balance. So this is a transfer into our account that the customer either paid us by debit card or through a checking account, and it did not come in processed through our POS system. It processed straight into our bank account. So this is something we need to add to our books because no transaction or no journal entry has been entered for this. We have interest revenue that we won't see until we get the bank statement. So once we see that we've earned $30 on interest revenue, this is another addition that we need to add to our books, right? A $30 deposit on the bank statement for interest earned not recorded in the cash account must add to the book balance. So we need to add that to our books balance. And then we have charges that we don't see until we see the bank statement, and that's a service charge for the bank that the services our account and provides different services for a lot of company and business accounts will have this. So a $20 service charge on bank statement not recorded in the company's cash account must subtract from the book balance. Now, we're going to keep on doing this because we also have an electronic funds transfer, an EFT payment to Waterworks. So this is something transferring out that we did not write a check for. So this is not something that we are accounting for, have a journal entry for. So this is something we need to subtract from our books to match our bank account. We have an NSF check, non-sufficient funds, from a customer on a bank statement. So we thought this is something we have in our books already as revenue and as cash received, but now we know that cash is no longer valid, that check has bounced, and now we need to put in a transaction or a journal entry that pulls that money back out. After recording all the items that affect the book balance, Smart Touch Learning determines the adjusted book balance and verifies that it equals the adjusted bank balance. Once we've adjusted both sides, they should equal, right? Once we've taken and added and subtracted the things that we needed to do from both sides, both sides should reconcile. They should equal each other. And so here's all the transactions that we're going to be completing for the book side. We're adding $100 in the account receivable from a from a customer. We're adding the $30 cash that we received in interest revenue. We're expensing out $20 for our service charge. We're expensing out utilities $40, and then we are going and not expensing. We are now, so when we receive the cash payment, we put that expense was paid and or that revenue was collected, and also the cash was collected at that time. But instead of that, now we are going to put that balance in accounts receivable. And so it's not an expense to us. Now that that account is no longer paid, it is a liability that, or it's still revenue, right? It's still an asset. It's now that the client owes us, they haven't paid us. So now we have to put that down as a liability or a accounts receivable. So the journal entries are posted to the Cash T account. So we put in our journal entries and we get with the new, the 100, the 30, the 20, the 40, and the 1200. Now we get an ending cash balance of 19,720, which should also add up to the $19,720 of balance that we have on a statement after we've added and subtracted what we needed to do there. So the ending balance of Cash T account equals the adjusted book balance and adjusted bank balance on the bank reconciliation. So, using the cash ratio to evaluate business performance. So the cash ratio, what is the cash ratio? It helps determine a company's ability to meet its short term obligation. So cash ratio equals cash plus cash equivalents, anything that can be turned into cash, very liquid things like savings accounts or debit accounts or things that are very liquid, right? Over total current liabilities. This is just to show, though we have some current assets, we're talking about current assets that are cash, pretty much cash and equal to cash. And just seeing, we're doing this to see if we actually had to pay off all of our current liabilities right now, could we do it in a cash basis? Cash equivalents are highly liquid investments that can be converted into cash in 3 months or less. So this can be money market funds, this can be like savings accounts, things that have some restrictions but are easily converted into cash, right? Maybe even accounts receivable that is within a 30-day period, right? So those we would say cash equivalents. So PepsiCo's cash and cash equivalents and total current liabilities from its balance sheet in millions. So let's look at the cash and cash equivalents. In 2021, they had 5,596 million in cash, and they had current liabilities of 26,220 million in current liabilities. And then in December 2020, they had 8,185 million in cash and cash equivalents. And in that same year, they had 23,372 million in current liabilities. So if we do the cash ratio, we can see that in 2021, they could cover, if need be, to cover the current liabilities, they would have to have covered 21, they could cover 21% of all current liabilities and paid in cash or cash equivalents. Excuse me. In 2020, they could have paid 35%. So their cash compared to current liabilities was a lot higher in 2020, and their cash, and you see this, their cash went down and their liabilities went up in 2021. So they were able to pay less. So this is something investors look at and others look at when they're trying to see if this company becomes solvent or if it gets into need where it has to pay off its liabilities, or it gets into trouble where it's not, creditors aren't giving it as much credit and they're closing accounts and they're making them pay off these debts, could this company pay off its current liabilities with cash? And how much could it pay off, right? How stable would it be if it had to use just cash? And in this scenario, you can see that Pepsi company was doing better in 2020 than it was in 2021. And investors will look at that and say, is this a safe company? Is it not a safe company? If they think that PepsiCo will kind of teeter or if they could run into trouble, they'll be less likely to invest in Pepsi because of that. Okay, so that concludes chapter 7. If you have any other questions or if you'd like to discuss any of the subjects on here in more depth, please reach out to me and I'd be more than happy to talk to you about it.